Plenty of fodder today because of earnings season. Thought we'd take a look at Scentre Group. Scentre Group has reaffirmed full-year guidance as its shopping malls continue to show resilience despite rising cost of living pressures, higher interest rates. This as opposed to 69% drop in first half net profit, while funds from operations were higher in the 6-month period. Retail property owners are facing headwinds amid a rapid escalation in interest rates, which is starting to take a bit of a toll on consumers. Official data shows retail sales volumes fallen for 3 quarters in a row, first time since GFC. Still, shareholders will see an increase to full-year dividends. The company forecasting minimum annual distribution 6.5 cents, up at least 4.8% on the prior year. Interesting, Citigroup has come out and said that Scentre Group beat guidance, and they're pretty positive going forward, and even though investors remain a bit cautious. What do you take out of that?
It's actually, I thought it was a very strong report,
Yep.
all things considered.
Yep.
The things that were interesting to me were the fact, though, that the actual percentage of sales for their specialty stores, so it's not counting their anchor tenants,
Yep.
is 16% now, where it was 18%. So in other words, the effective occupancy cost has gone down 2%. Right. At the same time that they've actually increased how much they're earning, which says that goes to the increase in sales.
Yep.
So sales have gone up for those retailers by 21% for the same period. It's a bit bad. Using 22 as a comparison period is not ideal, though, is it? Because it was coming off COVID.
Still an
I would have rather,
year,
I'd rather look at those things compared to 19 pre-COVID.
Yep.
It'd be more instructive.
Yep. Yeah.
So I would have asked that, anyway.
Yeah.
The problem is this is quite a complex, mature business, and they're running at 99.6% occupancy and so on. So if you look at it, you'd say, well, can this business grow? And apart from opening new shopping centres, which is limited, they've got a couple happening. It's a mature business, and our rents in Australia are right up there in the world by world standards. So I wonder whether they're shifting the relationship between fixed rent and share of sales or share of up. Yeah. Because from a retailer's point of view, I would rather have more variable cost. Yeah. So if I'm doing well, you do well, yes. And if I'm doing not as well, you don't do as well either. Whereas now Westfield have always liked, or Scentre Group obviously want to get as much as they can committed, but I would suspect there's been a shift in that. Okay. And that'd be a good thing probably.
Yep.
But overall it's really good. I mean, the problem as a business though, their return over the last 10 years has averaged 2.28% per year. Right. And that's because the capital price of the shares have gone down. So that's been negative 3% a year, and then they've had an average 4.48% dividend, 58% franked. Right. So the net result, if you've been a shareholder for the last 10 years, is pretty mediocre. Right. It's like just above inflation.
So not for you.
Well, no, because it's a well-run business, but it's just the economics of it. I can't see how they're going to improve that a lot. Okay. Where this would get up to be at least 10%, which with interest rates now at 5, you can get 5 for cash. Yeah. So unless Scentre Group start earning more, they're actually earning less than the cash rate.
Yep. Luke, what do you think of it?
I thought it was a good result and a good interview there, Koshi. I like the focus on the cash flow in the business. I think sometimes we can get bogged down too much into the valuations of these assets. And to me, unless you're talking about a private property fund where they control, the valuation of those businesses and the entry and exit price that you get as an investor, it's pretty irrelevant as public investors. I mean, you pay whatever the market's valuation is today, and Scentre, like a lot of REITs, currently trades at a decent discount to that NTA, which is the market's way of saying that those cap rates probably should be a little bit higher, but nonetheless, they're going the right way. I thought
he was very diplomatic on that. You'll need to ask the valuers. How did they explain it?
and of course, there's a great scene in The Big Short where the ratings agencies and what they did for the AAA bonds over there. It's something sometimes get pushed under the rug or just ignored a little bit. But anyway. Look, for the things they can control in this result, I thought it was pretty good. I mean, as he highlights, the strength of the underlying business partners, as they call them, the customers, is really strong. 9% retail sales growth, and that sort of goes, in line with the commentary we're seeing from the retailers so far. There's been a couple that have struggled, like Adairs was out the other day, which is pretty weak, but Premier Investments was out. JB Hi-Fi, some of the supermarkets guys, they're all reporting the same thing, which is the consumer just is much more resilient than what anyone would have expected them to be. So you see that reflected in this result from Scentre. I think Mark's spot on, though. You look forward, it's hard to see where really strong growth comes from with the business. I think at a shopping centre level, they're probably maxed out. They'll keep refurbing and refreshing and driving as Elliot pointed out, the entertainment value of the precincts that they're creating and driving some value in that way. But I think this is a stock you probably look at it from a distribution yield point of view. Right now it's about 6%. I think that's an okay yield. You could probably hold it if you're there. I think it's doing well in the current environment. But it's sort of not it wouldn't excite me too much, and you can probably actually get better yields out there in the REIT space. Potentially without that sort of retail exposure. We still have questions there. So, look, I'd say it's a hold for the program. But yeah, I thought it was a good interview and good points raised by Marcus.
Well, you can get, just adding to that, you can get far better yields just in the retailer, in their clients. Like Nick Scali, JB Hi-Fi and so on, way better.
Right.
They're 10%.
So you'd rather go for the retailer than the shopping centre owner?
No question.
Okay. All right.